America's balance sheet has entered uncharted territory. By June 2025, gross federal debt surpassed $36 trillion, roughly 123% of GDP, based on U.S. Treasury and BEA data. What does that actually mean, and why does it matter? In this documentary, we unpack the mechanics behind the number, how Treasury securities finance the deficit, who owns the debt at home and abroad, and the choices that pushed it higher over decades. We examine the consequences, from rising interest costs to budget trade-offs, and the policy options on the table. The goal is clarity and a realistic path forward. Clarity starts with the plumbing, how the debt is built, who holds it, and on what terms. The U.S. government finances itself primarily through Treasury securities. Marketable debt, T-bills, notes, bonds, tips, and floating rate notes, is auctioned to investors and traded every day. Non-marketable debt includes savings bonds and government account series securities held by federal trust funds, such as Social Security and Medicare. According to the U.S. Treasury, gross federal debt now exceeds $36 trillion. But economists focus on debt held by the public, the portion owed to investors outside the federal government. The remainder is intragovernmental, IOUs between federal accounts. Ownership is broad. Roughly 70% of publicly held treasuries are owned domestically, and about 30% are held abroad, based on Treasury International Capital data. At home, holders include the Federal Reserve, mutual funds and ETFs, pension funds, banks, insurance companies, and households. The Fed remains a significant owner even after quantitative tightening. Its portfolio still contains several $1 trillion of treasuries, shaping liquidity and the term premium. Abroad, the largest reported holders are Japan and China. As of 2025, Japan holds around $1.2 to $1.3 trillion. China's stake has declined to roughly $750 to $800 billion. Other sizable positions come via financial centers like the UK, Belgium, and Luxembourg, which often reflect custody for global investors. The terms matter as much as who holds the debt. Treasury has shortened and then gradually extended its maturity profile over the past decade. The weighted average maturity is a little over 6 years per the Treasury Borrowing Advisory Committee. After the 2023 debt ceiling episode, bill issuance rose, increasing the share of short-term debt, and with it, rollover exposure to current interest rates. Why this structure matters is straightforward. A larger foreign share can transmit geopolitical or currency shocks into U.S. funding markets. A heavier tilt to short-term bills makes interest costs more sensitive to Federal Reserve policy. And a broad domestic investor base supports market depth, but concentrates interest rate risk within banks, funds, and pensions. This is the foundation for understanding the economic implications to come. That foundation was built over decades of choices and shocks. Understanding how the balance swelled is essential to why it's so hard to shrink now. Historically, U.S. debt has surged in crises, then receded in peacetime. Gross federal debt peaked near 119% of GDP in 1946 as World War II ended, then fell dramatically for 3 decades as growth and inflation outpaced borrowing. By the late 1970s, debt was a much smaller share of the economy, but the trend reversed in the 1980s as tax cuts, a defense buildup, and 2 recessions expanded deficits. According to OMB historical tables, the 1990 and 1993 budget deals, followed by the 1997 Balanced Budget Act and Pay-Go rules, helped deliver budget surpluses from 1998 to 2001, briefly stabilizing the trajectory. The 2000 reset the path. The 2001 and 2003 tax cuts, the wars in Afghanistan and Iraq, and the creation of Medicare Part D widened deficits even before the financial crisis. Then the Great Recession hit. Emergency measures, including TARP, authorized up to $700 billion, and the 2009 Recovery Act, about $787 billion, combined with automatic stabilizers, pushed debt sharply higher. Debt held by the public roughly doubled as a share of GDP between 2007 and 2012, according to the Congressional Budget Office. Ultra-low interest rates kept carrying costs manageable, but the base level of debt was permanently higher. Structural pressures also mounted. As baby boomers began retiring around 2011, Social Security and Medicare outlays climbed faster than dedicated revenues. In 2017, the Tax Cuts and Jobs Act lowered the corporate rate from 35% to 21%, and reduced individual taxes, lifting deficits even amid low unemployment. Then came the pandemic. Congress enacted roughly $5 trillion in relief across the 2020 to 2021 period, from the $2.2 trillion CARES Act to the $1.9 trillion American Rescue Plan. While revenues dipped with the shutdown, gross debt vaulted above 100% of GDP and has continued rising. The result today is a mix of legacy war costs and crisis responses layered atop aging-related spending and a narrower revenue base. That history explains why America enters this decade with debt already at 123% of GDP, and why the economic implications now carry more weight. Which is why the next question is unavoidable. What does a 123% of GDP debt load mean for the economy now? The most immediate effect is the cost of carrying it. Net interest has become one of the fastest-growing lines in the federal budget. According to the Congressional Budget Office, net interest outlays were projected at $892 billion in fiscal year 2024 and $981 billion in fiscal year 2025, rising to about $1.6 trillion by 2034. Cumulatively, CBO's 2023 baseline put interest costs at roughly $10.5 trillion over 2024 to 2033. Later updates have pushed that figure higher. As a share of the economy, interest climbs toward 3.9% of GDP by 2024. More than the federal government historically spends on many domestic priorities. Those dollars are largely non-discretionary. When a bigger slice of revenue services debt, fewer resources are available for defense, infrastructure, research, or targeted tax relief. CBO estimates indicate interest will consume close to 1/5 of federal revenues by the early 2030s. That crowding out is fiscal, but it is also financial. Heavier Treasury issuance, especially at today's higher rates compared with the 2010s, can keep yields elevated and raise term premiums. The New York Fed's ACM model showed the term premium turning positive again in 2023 to 2024 after years near zero, a sign investors demand more compensation to hold longer-dated treasuries. Higher treasury yields ripple outward. Corporate borrowing, small business loans, auto financing, and mortgages price off the risk-free rate. A sustained rise in the 10-year yield raises debt service for firms and households, potentially depressing private investment. The Treasury's mix also matters. A larger share of short-term bills, which expanded after 2022, increases how quickly interest costs reprice when the Federal Reserve keeps policy rates above the near-zero levels of the last decade. Inflation is a subtler channel. Debt itself does not automatically create inflation, but large, persistent deficits during periods of tight labor markets and supply constraints can amplify demand pressures. The 2020 to 2021 fiscal response helped avert a deeper downturn, and also contributed to the inflation surge that followed, alongside supply shocks. With inflation easing from its peak but still a policy focus, sustained deficits complicate the Fed's job by anchoring term rates higher. There is also market confidence. S&P's 2011 downgrade, Fitch's 2023 downgrade to AA+, and Moody's negative outlook in late 2023 did not upend the Treasury market, but they signaled governance and fiscal risks. If political brinkmanship or liquidity strains recur, investors may demand a premium, raising costs further. In short, the economic implications are cumulative. Rising interest bills, tighter fiscal space, and borrowing costs that filter through the entire economy, setting the stage for hard policy trade-offs ahead. Those trade-offs now come into focus: taxes, spending, and the rules that govern both. According to the Congressional Budget Office, stabilizing the debt path would require persistent deficit reduction on the order of a few percentage points of GDP each year, sustained, not one-off measures. On revenue, 3 levers recur. First, enforcement. CBO has repeatedly scored IRS modernization as net positive for the budget, with the 2023 estimate showing roughly $180 billion in additional receipts over 10 years from an $80 billion investment before later rescissions. Second, base broadening, limiting high-end itemized deductions, addressing the tax gap, and tightening international profit-shifting rules and minimum taxes can raise revenue without headline rate hikes. Third, rate design. Policymakers debate corporate and high-earner rates, capital gains reforms, and the payroll tax base. On spending, the largest pressures come from health and retirement. Medicare savings are possible through site-neutral payments, curbs on Medicare Advantage overpayments, and continued drug price negotiation. MedPAC has found Medicare pays more per enrollee in Medicare Advantage than in traditional fee-for-service, suggesting room for tens of billions in annual savings if coding intensity is reined in. Social Security's trustees project the old age trust fund depletion in the 2030s. Closing the gap would require changes such as gradually raising the taxable wage cap, adjusting the benefit formula for higher earners, or modestly increasing the payroll rate, implemented over time to protect near retirees. Process matters too. Budget rules, pay-go enforcement, multi-year discretionary caps, and fiscal anchors tied to debt to GDP help keep savings from eroding. The U.S. achieved surpluses in 1998 to 2001 after multi-year packages in 1990, 1993, and 1997. Evidence that persistent, bipartisan frameworks can work. None of this is painless, but acting early spreads costs across cohorts and preserves market confidence. Waiting concentrates the pain and raises the risk of abrupt, recession-prone adjustments. That raises the practical question: where does the pain show up for households? The answer is diffuse through higher borrowing costs, tighter public services, and the growing share of tax dollars devoted to interest rather than programs that touch daily life. According to the Congressional Budget Office's 2025 baseline, net interest outlays are around the $1 trillion mark in fiscal 2025, now one of the largest federal line items. That means roughly $1.07 of federal spending goes to past borrowing, not current priorities. The trade-offs are tangible: less fiscal room for K-12 education support, infrastructure grants, disaster response, medical research, or targeted tax relief. Debt dynamics also filter directly into household finance. Higher Treasury yields lift borrowing costs across the economy. Mortgage rates remain elevated compared with the 2010s. Auto loans and small business credit have followed. Federal Reserve data show average credit card APRs holding above 20% through 2024 to 2025. And student debt is pricier. The U.S. Department of Education set 2024-2025 fixed rates at 6.53% for undergraduate direct loans, 8.08% for graduate, and 9.08% for PLUS loans, reset annually off the 10-year Treasury. For many families, that translates into larger monthly payments and slower wealth building. Entitlements are another pressure point. Trustees have warned that, absent reforms, Social Security would pay only about 4/5 of scheduled benefits once its trust fund is depleted, triggering across-the-board cuts for retirees. The longer adjustments are delayed, the more likely solutions lean on steeper tax increases, sharper benefit trims, or higher eligibility ages, outcomes that fall unevenly across generations and income groups. The ripple effects extend to communities. State and local governments borrow in markets tied to treasuries. Higher yields can mean costlier school bonds, deferred maintenance, or pressure to raise fees and property taxes. Savers, by contrast, have benefited from higher yields on T-bills and deposits, but with greater market volatility and fiscal policy uncertainty, including ratings pressure since Fitch's 2023 downgrade and Moody's ongoing negative outlook. In the end, national debt isn't abstract. It shapes paychecks, prices, pensions, and the resilience of public services. The open question is and how quickly policy choices will spread the costs more fairly and predictably across time.